Welcome to this video. So I'm going to talk about the dividends and how they actually fit into the strategy of the buy, borrow, die framework. Now, I'm not against dividends. They are good for certain people, especially if you're in the lowest tax bracket or someone who's retired who needs cash flow. But when it comes to this strategy, the math just shows it's not as superior as chasing a growth portfolio. What I really found from research and looking into this extensively is it's more of a psychology and dopamine hit, seeing the investment working when the investment gets paid to the account, the dividend gets paid on a quarterly basis. But really the math is pretty brutal when we look at comparing it to the strategy. So I'm going to use a few examples. I'm going to compare it to a US Treasury. I'm going to compare the NASDAQ versus the Charles Schwab ETF and just use a complete case study, and you can make your own mind up. So we're going to just use a standard comparison. Both investors start with a $2 million initial capital and they both need 100 grand for lifestyle. I'm just using tax on dividends at 20% over 15 years. This is keeping it sort of a dividend yield of 6%. And let's just say the stock grows 4% over 15 years, which is pretty good for a dividend stock. So you're getting 120k in dividends, the IRS takes 24k, you're left with 96. So you do need to sell stock to make up the difference. The dividend isn't giving this person enough money to live on, and that's a $2 million portfolio. Can't even give them 100k to survive, which I found not really ideal. Let's compare it to the NASDAQ investor with the same investing capital. They get a small dividend, they use margin, and I've even gave it 10% growth, right? That's conservative because it does usually, over the last 5 years, it's done 16%. Okay, so straight to the actual numbers, right? 15 years, the dividend investor has effectively doubled their net worth over 15 years. That is not good for me. For me personally, that's not actually beating inflation. Whereas the operator has made $2.3 million more. So their actual gross net worth is 8.3 million. And hopefully you can see that. Yeah, look, right at the very bottom of year 15, net worth 6.5 million versus 4.1. And most importantly, the person who's invested in, say, the growth, they were able to use the full 100k margin to fund their lifestyle. Whereas the first investor, dividend investor, had to sell assets because of the tax drag. Whereas the growth investor only had to pay a very small amount. They got 8k in dividends, so they paid a small amount of tax. You can see the difference there. Even on the growth investor, it violently outperformed the cost of the debt as well. Right? This is why the strategy can't really work with dividends, because we need the capital growth. The top investors of the world don't really care too much about a dividend. A dividend is like a nice to have. See, if you've got big growth companies, big tech companies do pay a dividend. It's just very small because they need the money to reinvest into the business. When you see something like a 6%, 8% dividend yield, that really to me is like a bribe. You should be saying, like, why are you bribing me here? Because the CEO is just admitting, I have no idea how to grow this company, so I'll just give you the money back. And what a lot of retail investors fail to understand is it's really just they're just getting their money back and paying tax on it. So the market cap includes the cash the business has. So if Microsoft has like $100 billion in cash and they spend $10 billion on the dividend, that comes off the market cap technically. So when you see the stock price drop and they get a dividend, really they're just getting the money back. It's when you look at it like that, it just doesn't feel appealing. And this is me talking about heavy dividend paying stocks. Let's look at, like, say someone was really bribed in an 8% yield, and let's fight against a US Treasury. Yeah. Now, a US Treasury is zero risk. They just print the money and give it to you. Whereas a company is a board of directors making a decision. Are we going to pay a dividend out? Maybe, maybe not. So the stock, if it is paying such a high dividend, how does it grow? They can't grow if they're giving the money back to you. So here's an example. I've used 24% federal tax bracket. I've used a 15% tax, and the Treasury's taxed at 24%. So let's see what you can see here, right? So this is 100 grand on an 8% yield. The net cash coming in, you're only getting a 2.8% yield, because what I've done is I've factored in the fact that the business can't sustain that. It may drop 4% year over year because they're paying this dividend out. They're giving the money back to you. Some very strong companies can fill the hole that they've just dug and maybe sustain the share price. But if you're these companies that usually are offering such a high dividend yield, they most likely need to cannibalize the company to pay the shareholders. You see, in the UK, the UK is obsessed with dividends and UK culture. I think Americans are more about capital growth. So it's a very UK mentality where they chase dividends in our country. But you can see in the comparison, even against a US Treasury, the US Treasury, even after tax, is yielded 3.4% against a company that's bribing you in and having to slowly cannibalize the company. Yeah. It's a fair comparison. That's a more fair comparison. I will compare the Charles Schwab as well, and you can see it even on a good ETF. But a company throwing you in an 8% yield can't even beat a US Treasury, and you've got to consider the risk. There's absolutely no risk on a Treasury. Let's look at. I've done this comparison. Charles Schwab, right? 23% capital growth over the last 5 years versus the Nasdaq, nearly 120%. So the dividend investor feels, it's a psychology. They feel like they can see the money coming into the brokerage account, and it feels good. Problem is, again, here on this yield of 3.5%, it's just not enough to live 100 grand a year on with $2 million. Look. So this is important. $2 million, they need 100 grand a year to live. They're getting 70,000 in dividends. The IRS takes 10.5k. They need more for lifestyle, so they need to sell shares, and they're getting a tax drag, and they're cannibalizing the principal, and it's grown at around 4.4%. So after 5 years, their net worth is now $2,275,000. They've paid $55,000 to the IRS. Okay, so again, has that even beat inflation? Compared to the operator who opted in for the Nasdaq, they do get a dividend, about 0.5% yield. They only pay the IRS $1,500. They get 10,000 in dividend, and they borrow the rest of the money in a margin loan. Margin loans at 5%. They pay zero taxes on borrowed money. Do not sell any shares, and it's compounded at 16% over the duration. They end up with a net worth of 3.8 million. the gross portfolio is 4.3. And that the gross portfolio is what compounds. Okay, the net worth just factor in the fact that there's a 500k debt. So look at this comparison. The dividend investor has paid more taxes and they have less net worth after the 5 years. This is why I'm asking, is it just psychology, comfort? Is it comfort? They like to see the dividend working. The top operators, this is why the family offices are just not chasing dividends, because capital growth and withdrawing the money is fine. I would rather the company takes the money, the free cash flow, either does buybacks or just makes the company stronger. I would rather that. Is it a big tech company? Is it building data centers? Or is it, a defensive company building infrastructure, just making their moat impenetrable? I would personally rather that than a dividend. I just think a dividend for me is just a nice to have. If you're in a low tax bracket and you need cash flow, that's really, a dividend has its place for certain people. But it just is, the numbers just don't compare to a growth strategy. So the fundamental strategy doesn't work. Buy, borrow, die just doesn't work for a full-on dividend investor. You need the capital growth and you need to be able to deal with the volatility, because the volatility is going to come and we're prepared for it when it happens. This is why Warren Buffett and Charlie Munger, they never paid a dividend. They said, we can invest the money better than you, so let us deal with it. And I would rather that. I don't want to ask a genius for a dividend. If these are the best companies in the world, true monopolies, you can keep the free cash flow, because really they're just forcing a taxable event on you. The whole point of the strategy is to minimize taxes. And I think dividend investors want the best of both worlds. They want the dividend and they want the capital growth, and it's just against physics. But they'd quite happily see the money coming into the broker account and the share price goes down with it, and they don't care. It's like an illusion. It's comfort. So never ask a genius for a dividend. I like buybacks. We want buybacks. They're tax free. It's the same thing. It's the same thing when you look at it. But yeah, just a quick video on the dividends. This is why the family offices were not chasing down dividends. I like the growth. We want the growth. Fine if a defensive company has dividends, so be it. But it's not the reason. It's not the reason we buy a stock. It's not the reason I buy a stock. I honestly don't even look at the dividend yield when I'm looking at a stock. I'm looking at the company. I'm looking at its moat, pricing power. Is it a monopoly? What's the free cash flow like? So there you go. There's the math. When you see the math, you can't negotiate with it. And we can't have it all. So just a quick one today.